tuje kemye. Izuba rirabuye riyageze hagati, saa sita z'umunota zirageze. Ntekerereye aho ubanye ubuzima bwanjye, umutima wanjye uzuye gushima. Nakangutse mu gitondo uramfata, undinda ibikuba n'imitego y'umwanzi. None dore ngezemo amahoro, Mwami Yesu warakoze rwose. Yesu wanje ubuntu bwawe ni bwiza, ungose kuba mu gitondo na n'ubu. Shime kompase ubugingo kubawe, ndagushimiye kuri saa sita nziza. Amasaha ari bukurikireho ndayakuragije, genda nanje Mwami. Ubuntu bwawe bubanire nanje kugeza munsi urangiye. Yesu wanje, tambaraga zanje zangize wondiwe, nkana ubwenge bwanje bunganja. Ni urukundo rwawe rutagira urugero, ni ubuntu bwawe bungoboka buri munsi. Mu mahano n'umuryango w'inzira ndefu, intambwe zanje uzirinda kuyoba. Yesu uratatswe uri wagihamya, umugisha n'icyubahiro biwukwiriye. Yesu wanje ubuntu bwawe ni bwiza, ungose kuba mu gitondo na n'ubu. Shime kompate ubugingo kubawe, ndagushimiye kuri saa sita nziza. Amasaha ari bukurikireho ndayakuragije, genda nanje Mwami. Ubuntu bwawe bubanire nanje kugeza munsi urangiye. Alleluya. Amasengesho muijwi ya buhoro, yo amasari mbere na yawe. Ubuntu bwawe ungane, haleluya. Tuje kemye. Izuba rirabuye riyageze hagati, saa sita z'umunota zirageze. ntekerereye aho ubanye ubuzima bwanjye, umutima wanjye uzuye gushima. Nakangutse mu gitondo uramfata, undinda ibikuba n'imitego y'umwanzi. None dore ngezemo amahoro, Mwami Yesu warakoze rwose. Yesu wanje ubuntu bwawe ni bwiza, ungose kuba mu gitondo na n'ubu. Shime kompase ubugingo kubawe, ndagushimiye kuri saa sita nziza. Amasaha ari bukurikireho, ndayakuragije genda nanje Mwami. Ubuntu bwawe bubanire nanje kugeza munsi urangiye. Yesu wanje tambaraga zanje zangize wondiwe, nta n'ubwenge bwanje bunganja, ni urukundo rwawe rutagira urugero, ni ubuntu bwawe bungoboka buri munsi. Mu mahano n'umuryango w'inzira ndefu, intambwe zanje uzirinda kuyoba. Yesu uratatswe uri wagihamya, umugisha n'icyubahiro biwukwiriye. Yesu wanje ubuntu bwawe ni bwiza, ungose kuba mu gitondo na shime kompatse ubugingo kubwawe, ndagushimiye kuri saa sita nziza. Amasaha ari bukurikireho, ndayakuragije genda nanje Mwami. Ubuntu bwawe bubanire nanje kugeza munsi urangiye. Alleluya, Yesu witwira buhoro, yo amasari imbere na yawe. Ubuntu bwawe ituje kene, izuba rirabuye riyageze hagati, saa sita z'umunara zirahageze. Ntekerereye aho ubanye ubuzima bwanjye, umutima wanjye uzuye gushima. Undinda ibikuba n'imitego y'umwanzi. None dore ngezemo amahoro, Mwami Yesu wose. Yesu wanje ubawe ni bwiza, ungose kuba mu gitondo na n'ubu, shime kompase ubawe, nagushimiye uri saa sita nziza, amasaha ari bukurikire, ndayakuragije, genda nanje mwami, ubuntu bwawe bubanire nanje, kugeza munsi. Yesu wanje, tambaraga zanje zangize wondiwe, wenge wanje ni urukundo rwawe rutagira urube, urukundo rwawe bungoboka buri munsi, mu mahano n'umuryango w'inzira ndefu, intambwe zanje uzirinda kuyoba, turatatswe uri umwanya, umugisha n'icyubahiro biwukwiriye. Yesu wanje ubuntu bwawe ni bwiza, ungose kuba mu gitondo na n'ubu, shime kompase ubugingo kubwawe, ndagushimiye kuri saa sita nziza, amasaha ari bukurikireho, ndayakuragije, genda nanje mwami, ubuntu bwawe bubanire nanje, kugeza munsi urangiye. Hallelujah.
It was amazing to praise God so that we may start our course. Waiting hours to be okay. Let me just start, and I hope that's okay as per now, because of the previous courses. As we are seeing today, we are in financial accounting and adjusting entries. Why do we talk about adjusting? We talk about adjusting because there may be errors. There may be errors, and those errors need clarification, being adjusted, so that anyone can get us. Errors are when we commit an error in accounting, it causes some problems, and those problems need clarifications, need to be adjusted. Yes, that's why we start by adjusting. We are seeing that in chapter 1 and chapter 2, we described the recording and reporting of economic transactions. Yes, in details. We have seen, yeah. Now, however, the account balance used to prepare the financial statement in days previous did not necessarily reflect the correct amount. Now, in this chapter 3, to introduce the concept of adjusting entries and how does it satisfy the matching principle ensuring revenues and expenses are reported in the correct accounting what period. The preparation of an adjusted trial balance is discussed as well as its use in completing financial statement. At the end of the accounting period, after financial statements have been prepared, it is necessary to close temporary what account to retained earning. By meaning retained earning, we understand one thing. That means retained earning, its part or its chamber is in balance sheet. So to transfer that amount of interest the company have earned, we have to make sure that the retained earning is well closed. The necessary closed temporary account to what? To that retained earning as finished to say. And that's this process is introduced in this chapter as is the preparation of a post-closing trial balance and the accounting cycle, the step performed. Each accounting period starts that result in financial statements, of course, is also reviewed. Uh, we have to be sure that all of those transactions were recorded. Now, those are some of the running objectives. Wait me a little bit. I'm gonna finish to see whether we have sufficient what? In order to continue. Those are we have to see in our there's a generally accepted account require the recording of adjusting entries. Now, the second thing we will be able to understand is that we will be able to explain the user in the prepare the adjust required for preparing expenses, depreciation, unearned revenue or unrealized profit, the accrued revenue and the accrued expense as well. Okay, it was an issue of internet.
We start with the presentation, framing the public state. Track flows in and out before it gets too late. Policies, estimates, errors keeping choices clean. Foreign exchange rates converting every scene. Backed up, count from exchange transactions. The people said, oh, balance of public funds, keep the numbers clear. IPSAS guidelines ruling year to year. From roads and schools to social care, accrual accounting everywhere. Debit the assets, credit the liabilities right. Bringing public sector finances to the light. Inventory stocked up, medical supplies in store, investment property earning
Now we are continuing. Hope the problem was just in financial transactions. Uh, Financial transaction occurs continuously during an accounting period as part of operating activities. For Big Dog Corax Corp, this sequence of operating activities takes the following form. Operations began with some cash on hands. Is used to purchase supplies and to pay expenses. Yes. Revenue is earned as repair services are completed for customers. Cash is collected from customers. This cash to cash sequences of transaction is commonly referred to as an operation and is illustrated in the figure that we are going to see. Cash is on hand. Repair services, repair supplies are purchased. You have cash, then you go to purchase goods. You see here on the second transaction, expenses are paid. After receiving your purchases, you're required to pay all of those transactions that have been mentioned or what you have purchased. You have to pay current obligation as a current liability, or even in cash in hands is in hand. There's no need for liability. You have to pay cash as well. Now this expense is made now. Then the repair accounts receivable results. Why does account receivable result? That because having some customer who paid on credit or who you have served on credit, then they become already potential account receivables. Cash is collected from customers. Now, after getting that, after cash is being collected from customer, this is the end of what? One accounting cycle. One operating cycle, because these are in a transaction cycle. Good. An operating cycle, depending on the type of business, an operating cycle can vary in duration from short, such as 1 week, a grocery store, to much longer, such as 1 year. Example, a car, therefore, an annual accounting period could involve multiple cycles, as shown in this figure. You see, this is an accounting period. Starting from 23. You see? One accounting period, but multiple operating cycles. You see, we have an accounting period means from January to 31st of December. But do you see those are different operating transactions? Now, for example, in 1 month cycles, remember what is a operating cycle? An operating cycle is a whole going to purchase goods up to when customer. That is what we call operating cycle. Now, operating cycle within an annual accounting period, notice that not all of the operating cycle in the figure we have seen are completed within the accounting period. Since the financial statements are prepared at a specific time interval to meet the generally accepted accounting principles, all those requirements, it is necessary to consider how to record and report transactions related to the accounting period is incomplete or operating cycle. To generally accepted accounting principles, recognition and matching provide the guidance in this area and are the topic of the next section that we are going to see, recognition principle in more detail. Generally accepted the accounting principle provide the guidance about about when an economic activity should be recognized in financial what? In financial statement. An economic activity is recognized when it meets two main criteria. It is probable that any future economic benefit associated with the item will go to the business, and it has a value that can be measured with the reliability. Now let us see the revenue recognition as illustrated there. Revenue recognition is the process of recording revenue in the accounting period in which it was earned. This is not necessary when cash is received. Most corporations assume that revenue has been earned at an objectively determined accounting cycle. For instance, it is often convenient to recognize revenue at the point when invoice and or what has been to a customer, and the related goods have been delivered or services performed. This point can occur before receipt of what? The receipt of this can be made an asset called the account receivable and resulting in the following what? Entry. The entry that we are going to see. You see, we have general journal. We have account receivable, which should be debited, and revenue are credited. To record revenue earned on account, that is a narration. When cash payment is later received, the asset accounts receivable is exchanged for the asset. Cash and the following entry is made as well. You see, we have debited the cash. and account receivable, we have credited it. You see, to record cash received from credit customer now is the narration, differ from the previous narration, you see. Revenue is recognized in the first entry, the credit to revenue. Prior to the receipt of cash, the second entry has no effect on revenue. When cash is received at the same time that revenue is recognized, the following entry is made. You see, we debit cash, then we credit revenue. To record cash received from who? From our customer. When a cash deposit or advance payment is obtained before revenue is earned, a liability called unearned revenue or unrealized profit is recorded as follows as well. And account explanation, you see them. Cash is debited. Unrealized profit is credited. To record the cash received from customer for work to be done in the future. Revenue is not recognized until the service have been performed. At that time, the following entry is made. You see, unearned revenue is thus debited. Unrealized profit we debited, and the revenue is credited. To record the unearned portion of unrealized profit or unearned revenue. The preceding entry reduced the unearned revenue account by the amount of revenue earned. The matching of revenue to a particular time, regardless of when cash is received, is an example of accrual accounting. Accrual accounting is the process of recognizing revenues when earned and expense when incurred, regardless of when cash is exchanged. Now, it forms the basis of generally accepted accounting principle. Recognition of expense is discussed in the next session. Now, you see, expense recognition, we finished the income recognition. Now, expense recognition in a business, costs are incurred continuously. To review, a cost is recorded as an asset if it will be incurred in producing revenue in the accounting period. Remember, in our previous chapter, we have seen what? The meaning of asset. Yes? Asset now is a result of past event that have future economic benefit. That is the meaning of asset. So in the past event, we made having occurred the expenses. That is what now they are telling us. A cost is an expense if it will be used for or consumed during the current period to earn revenue. This distinction between types of cost outlay is illustrated in the figure that we are going to see. Financial accounting, you see that cost outlays is well two main types. It's recorded as assets when costs are incurred to produce revenue in accounting period. For example, prepaid rent, prepaid insurance, and unused surprise. Now, the cost outlay is recorded as expense when costs are in the present accounting period. For example, rent expense, insurance expense, and office supplies electricity, all of those costs that are incurred in the current accounting period, they may be recorded as expenses. Now, you see the interrelationship between assets and expense. Now, you come up with that idea. In a previous section regarding revenue recognition in journal entries, illustrated three scenario where revenue was recognized at the same time as an after cash was received. Similarly, expense can be incurred before at the same time or the after cash is now paid out. An example of when expenses are when the utilities February. In this case, an account payable is increased in January as flow. You see, we have just switch expenses. We have to debit it as well. Now, account payable or utilities payables to record journal entry utilities expected to be paid in February. Utility expense is reported in the when the January utilities are paid in February, the following is recorded. We have debt. We have general journal details, accounts payables, or utility payables now is debited. And cash is now credited. To record payment in February of utilities used in January. Yes. The preceding entry has no effect on expenses reported on the February income statement. Expenses can also be recorded at the same time that cash is paid. For example, if salaries for January I paid on January 31st, the entry on January 31st is, you see, salaries expenses are debited. The cash is now credited there in the contra side. To record, the narration is to record payment of January salaries. As a result of this entry, salary expenses is reported on the January income statement when cash is paid. Finally, a cash payment can be made before the expense is now incurred, such as the insurance paid, you see, in advance. There are some things that we have to pay in advance, like there are salaries, there are insurance. Some salaries are paid in advance. We have rent. All of those expenses are paid in advance. Now you see, prepaid insurance is debited. Now we have cash is credited. Now the narration is to record payment of insurance in advance. As the prepaid insurance is used, it is appropriate to record or report an expense on the income statement by recording what? The following entries. Remember, insurance expense have been debited, and insurance expense was being debited as expense as well. the prepaid insurance now is just credited to eliminate such a transaction. Now, the narration is to record the use of prepaid insurance. The preceding example illustrates how to match expenses to the appropriate accounting period. The matching principle requires that expense be reported in the same period as the revenue they helped generate. That is, expenses are reported on the income statement. A, when related revenue is recognized. Or B, during the appropriate time period, regardless of when cash is paid. To ensure the recognition and matching of revenue and expenses to the correct accounting period, accounting balances must be reviewed and adjusted prior to the preparation of financial statements. This is the topic of the next session that we are going to see. You see, now adjusting entries. I want you to be now open-minded. At the end of an accounting period, before financial statements can be prepared, the accounts must be reviewed for potential adjustment. This review is done by using the unadjusted trial balance. The unadjusted trial balance is a trial balance where the accounts have not yet been adjusted, ever. The trial balance of Big Dog Corporation as the company that we are doing on at January 31st was prepared in chapter 2, they appear in this chapter below. It is an adjusted trial balance because the account has not yet been updated for adjustment. You see, we will use this trial balance of that company, Big Dog Co-work. Yes. It is an adjusted trial balance because the accounts have not been updated for adjustment. We will use this balance to illustrate how adjustments are identified and they recorded. We remember there's figures in chapter 1 and chapter 2. Now, we have cash, which is debited at that amount, and all of those transactions which have been recorded as well. Cash, account receivables, what else? Account receivable have prepaid insurance. We have prepaid insurance equipment. All of those transactions have been illustrated before, I know. Now, we have figure 3.4, which is an adjusted trial balance of Big Cowork at January, that's the month. I think that we have seen all of this transaction in chapter 2. Now, adjustments are recorded with adjusting entries. The purpose of adjusting entries, remember, is to ensure both the balance sheet and the income statement faithfully represent the account balances for the accounting period. Adjusting entries help satisfy the matching principle There are five types of adjusting entries as well. Well, we are going each of which will be now discussed. We see we have adjusted prepaid assets. When we have prepaid assets, this is an income. Adjusted unearned liability, which will be an a liability, of course. Adjust plant and the equipment assets. Here we say depreciations. We say adjust for accrued revenues. Adjust for what? Accrued expenses. Let's start by an accrued revenue. It is a revenue that has been earned but not been corrected or recorded. We have an accrued expense, which is an expense that has been incurred but has not yet been paid or recorded. We have adjusting prepaid assets account. Yes, an asset or liability account requiring adjustment at the end of an accounting period is referred to a mixed account because it includes both a balance sheet portion and an income statement portion. The income statement portion must be removed from the account by an adjusting entry. Remember, income statement provide us the interest that we will be using in what? In the balance sheet. Now that's why they are telling us that income statement portion must be removed from the account by an adjusting entry. Refer to this figure which show an adjusting balance in the chapter month insurance policy that went into effect on January. You remember this transaction in chapter 2. Now we have the unadjusted trial balance shows the following balance in the prepaid insurance account. In chapter 2. So that very well. Where that those two four have coming from. We are seeing every transaction independently. You see, I find it. You see here, we debit an asset account prepaid insurance is increased, resulting in a debit because the insurance provide the future benefit is recorded as an asset. They are saying Big Dog Cowards paid 2,400 cash for a 1 year insurance policy effective January 1st. It was paid for a 1 year. Now I hope it's clear. prepaid insurance, the unadjusted trial balance shows the following balance in the prepaid insurance account. Those are what we are seeing. That the balance resulted when the journal entry below was now recorded. Remember, we debit prepaid insurance, then we credit cash, because those cash have gone to pay this prepaid insurance as well. This transaction is clear. At January 31st, 1 month for US dollar of the policy has expired, been used up, calculated. You take 2,400, then you divide by 2. For recording the transaction for January, the adjusting entry on January 31st to transfer 200 out of the prepaid insurance and into insurance expenses now here. We debit insurance expense by 200. Yes. Then you credit prepaid insurance because prepaid have been debited before. Now we are going to reduce it up to the last month of the year, which is December. To adjust for the use of 1 month of prepaid insurance, that is the narration. Do you record this journal as that? As shown below, the balance remaining in the prepaid insurance account is 2, that is the remaining 2,200 after the adjusting entry is posted. Now, the 2,200 balance represents the unexpired asset that will benefit future period, namely the 11 months from February to December 2023. There's a 200 US dollar transferred out of prepaid insurance is posted as a debit to the insurance expense account to show how much insurance have been used during January. We have insurance expense of 200, which have been removed. You see, we've been credited prepaid insurance. We removed there's 200 up to the insurance expense already has been gone there. Before it was an asset, now it become an expense. An expense account insurance expense is now increased by the amount used. An asset account prepaid insurance is decreased by 200 of insurance coverage that was used during January. If the adjustment was not recorded, assets on the balance sheet would be overstated by 200 US dollar, and the expenses would be understated by the same amount on the income statement. That is clear. Now, adjusting an unneeded liability account. You see that on January 15, Big Dog received 400 US dollar cash payment in advance of services being performed. The unadjusted trial balance shows the following in the unneeded repair revenue account. We have unneeded repair revenue of, we credited them 400. We have debited cash, then we credited unneeded repair revenue. The receipt of 400 US dollar advance payment was recorded as follows. You have seen there. You have this. I'm finished to say. Because even though it is not yet earned, but already cash have been received. What we will be removing is the profit, but we have assets, which will be part of liability under balance sheet. This advance payment was originally recorded as an earned since the cash was received before repair service were performed. At January 31st, 300 US dollar of the 400 US dollar unearned amount has been the adjusting entry at January 31st. Now is what we have 31st, the general journal. We report the debt, then we recognize the unearned repair revenue, which is equal to 300. Now we credit repair revenue with the same amount of 300 to adjust for repair revenue earned. Now, after posting the adjustment, the 100 US dollar remaining balance is unearned repair revenue, which is equal to 400 US dollar minus 300 US dollar. Now we will see that it represents the amount of at the end of January 31st that will be earned in the future. Unearned repair revenue we have how much? 400, but we debit 300. Now in the repair revenue, there's a 10,000. So we are going to add 300 in the credit side. We reduce the unearned repair revenue with 300. Then in the revenue we credit so that the revenue has been increased. Under the adjusting liability account, unearned repair revenue is decreased by the 300 US dollar adjustment. You see? A revenue account repair revenue is increased by the 300 US dollar adjustment as well. If the adjustment was not recorded, unearned repair revenue would be overstated too high by 300 US dollar, causing liabilities on the balance sheet to be overstated. Additionally, revenue would be understated too low by 300 US dollar on the income statement if the adjustment was not recorded. Now, allow me to go on adjusting plant and equipment.
They say debit the bought the office supplies, but I forgot to write it down. Error of omission, missing data in the town. To fix it, simply recurred the full entry, debit, credit, cash. To James, mixing up the names. Fix it, credit James to take it off. Debit Johnny to set it right. Bought a delivery van but called it vehicle repair. Error of principle, fundamental rule. Capital expenditure logged as an expense. To fix it, debit the asset account. Credit repair to restore sale.
Continue. So adjusting and equipment account. plant and equipment assets, also known as long-lived assets or fixed assets in some cases. Long-lived assets are now expressed to help generate revenues over the current and the future accounting period because they are used to produce goods, supply and services, or used for administration purposes. Now, that is the rationale. That we have truck and equipment purchased by Big Dog Corox Corporation in January are we see an example of plant and equipment just purchased by Big Dog Corox Corporation. You see, they are clear. The truck and equipment purchased by that company in January are example of plant and equipment assets that provide economic what? Economic benefits for more than one accounting period. Because plant and equipment assets are useful for more than one accounting period, their cost must spread over the time they are what they are used. This is that satisfy the matching principle. For example, the 100 and the cost of a machine expected to be used for over 5 years is not expense. No, it's not expensive the entire in the year of purchase cause expense to be overstated in year one and understated in year two, three, and four, as well and five. Therefore, all of those hundreds thousand US dollar cost must be spread over the assets 5 years life. Now, the process of allocating the cost of a plant and equipment assets over the period of time is expected to be used now is carried what depreciation? Yes, depreciation is the amount of depreciation is calculated using the actual costs and an estimate of the asset is useful life and residual value. Yes, the useful life of a plant and equipment asset is an estimate of how long it will actually be used by the business, regardless of how long the asset is expected to last. For example, a car the manufacturer is suggested the life of 10 years, but a business may have a policy of keeping cars for only 3 full life for depreciation purpose would be years and not 10 years. The residual value now is an estimate of what plant and equipment assets will be sold for when it is no longer used by who? By a business. Because our business is the one who is just using it. The residual value can be zero. There are different formulas for calculating depreciation, of course, but we will use the depreciation. What is the formula? to catch up the formula now. Okay, I was telling you that that formula is the easiest one of the formula of straight line method is easiest. You take cost, you remove residual value, then you continue to you divide with the useful life, expected useful life, then you use them in the give the in those periods of the or the period at which you are just calculating. Remember, there is a uniformity principle whereby you can't use this accounting policy in this year, then you use another accounting period, accounting report, sorry, in the next year. No, you have to take the same accounting policy through different years. Now, see, the cost less estimated residual value is the total of that asset. Or the straight line method allocates the depreciable value over the assets is estimated. That is the general principle, general rule. That is it, the general rule of that for that application or policy. The straight line method allocates that equally over the useful life of all of these assets. When recording depreciation cost equally useful life, then expenses are just as are a depreciation. Now, our initial instinct here is to debit depreciation expense and credit the plant and equipment assets account in the same way prepaid expense, remember, were adjusted with a debit to an expense. And then yes. However, crediting the plant and equipment assets account is incorrect. Instead, a contra account called accumulated depreciation must be credited. Yes. A contra account is an account to another county and typically has an opposite is subtracted from the balance of its related what? Of its related account on the financial statement. Accumulated depreciation records the amount of the asset is a cost that has been expensed since it was put into use. Now, accumulated depreciation has a normal credit balance that is subtracted from my plant and equipment asset account on the balance sheet. That is normal. Initially, the concept of crediting accumulated depreciation may be confusing because of how we learned to adjust prepaid, debit an expense, and credit the prepaid. Remember that prepaid actually gets used up and appear over time. What does it mean? We have a prepaid of something. We have seen an insurance example of prepaid insurance. We have seen an example of like depreciation. You remove it, you remove until your prepayment have been come to an end. Yes. Now the goal is in record depreciation is to match the cost of the assets to the revenue it helped generate. For example, we have a 50,000 US dollar truck that is expected to be used by will have its cost of plant and now in the chapter we see the adjusting journal entry to record the depreciation is this one. Look out on your screen. On your screen, you see that we have debited the depreciation and we have credited as well the accumulated depreciation by a given amount. To adjust, that is the narration. Now, subtracting from the plant and equipment as account balance equal the carrying amount or net book value of the plant on the balance sheet should be equal amount. When we talk about carrying amount, is the value, the historical value of an asset less accumulated depreciation. That is what you call net book value of an asset. Good. Now let's walk through two examples to demonstrate depreciation adjustments. Big Dog Corporation, January 31st, 2023, and adjusted to the following two plant and equipment assets. Asset number one was equipment. Asset number two was a truck. Equipment worth 3,000 US dollar and truck worth 8,000 US dollar. Now, the equipment was purchased for 3,000 US dollar. The equipment general ledger account appears as follow. We debit equipment by 3,000 US dollar. Yes. Then we credit cash. The balance resulted when this journal entry was recorded. That one we have finished to do. That's where this asset, because it has an estimated user for life greater than 1 year. Assume its actual user for life is 10 years. Remember, 1 year is 12 months. Yes, 1 year is 12 months. Are you seeing the the table, or I will not yet shared it to you. I was telling you 12 months. 12, when we talk about 10 years, 10 years and 120 months. Because calculating what? Calculating days is a crucial thing in a depreciation. Want to know how to manage days in a depreciation you face? I think it is understanding what does or how to compute. It's simple here. You take 10 years, then you multiply by 12 months, give you 120 months. And the equipment is estimated to be worth zero at the end of what? At the end of the useful life of everything. Residual value. Now, let us apply the formula. You take 3,000 US dollar minus residual value of zero divided by 20 months. We are seeing that the depreciation is equal to 25 US dollar per each month. Note that the depreciation is always rounded to the nearest whole. When you get that is when you say your result is 0 point something, you are round it to 1. That's what they are saying. This is because depreciation is based on estimates, an estimated the residual value and an estimated useful not exact. The following adjusting journal entry is made of this at first. Good. Equipment worth 3,000 US dollar. Accumulated depreciation. Now we have been credited by 20,000. We take we have debited depreciation, yes. The depreciation comes from accumulated depreciation. Yes, we have equipment of 3,000. It was debited, of course. Now, in accumulated depreciation, we will be removed. It goes twice. We debited depreciation for this current year, but the same time, under accumulated depreciation, it will be just over there of that equipment, because the equipment loses value automatically. In our net book value, that's what they are saying. The equipment account remains unchanged by the adjusting entry. A contra account accumulated depreciation is increased by 25. Depreciation expense is now increased by 25 as well. The amount of the equipment cost that has been allocated to expenses. Now they are saying for financial statement reporting, the assets and the contra assets account are combined. The net book value at January 31st, 1 month of track cost has expired since it was put into operation in January using the straight line method. Depreciation is calculated the same way. You see, we take cost of 8, remove what is residual value, then you divide by 8 months. That is easy. We get when you get things that is not exactly $1, you round it to $1. The adjusting entry recorded on January 31st. Depreciation expense track. Then we debit 100. Accumulated depreciation track, we credit it. To adjust for 1 month of depreciation on the track, that is the narration. You see, when the adjusting entry is posted, the account appears this way. You see, look at here. After adjusting, remember this is before adjusting entry January 31st is that one. When now adjusting entry posted, you look. We have been debited the track. The accumulated depreciation has been increased and the depreciation has been increased. That's how we do all of this transaction for statement reporting. The asset and the contra asset account are now combined. The net book value of the track on the balance sheet is shown as 70,900 because you have removed the 100 of what depreciation. You see? Depreciation adjustments are not recorded. Assets on the balance sheet would be overstated and stated on the income statement, causing when the depreciation adjustments are not recorded, asset sheet would be now overstated. Additionally, expense would be understated on the income statement. It automatically become the effect on net income is overstated. If net income retained earnings on the balance sheet would also be overstated because they are correlated. It is important to note that land is a wrong riveted asset or a fixed asset. We call it a fixed asset as well. However, it is not depreciated because it does not get used up over time. You can say your land is being depreciated, no? Further, yes, amortization. Therefore, land is often referred to as a non-depreciable asset. Adjusting for accrual revenue. That is accrual revenue. Let's take a little break, then we can adjusting for accrual revenue.
Yeah, we holding control. Let's combine the numbers and construct the whole. away the noise. Through financial statements, that's the real big flex. More than 50 plus one, that's control. Step inside, now the takeover's done. Got a subsidiary rolling under the umbrella. Consolidation time, let me break it down, fella. Rule number one, take the revenue and cost. Add them 100%, no details get lost. I set for asset liability to match at the whole balance sheet. Every single patch, hold up, don't double count the intercompany trade. Cancel out the sales and the management fees paid. The parents sold the sub and they kept a realized gain. Eliminate the profit or the margins won't stay safe. Real controllers 99, subsidiary numbers. We had them love on the get that share. Yeah, we show them some respect and a minor influence. It's the equity effect. Cancel out the internal, wipe away the noise. The financial statements, that's a real big flex. Now, what if we don't own 100% of the piece? Into NCR, now controlling interest lease. They own that remaining bit, 20 or 30%. Show the sharing equity, where they went. Now look at company 3, we got significant influence. Got 20 to 50%, I control just that ain't a sub, that's an associate in the net. No line by line added, that's a standard you reset. Highest 28 equity method on the scene. Start with initial cost, keep the ledger fresh and clean. Add our share of the profit to the single line asset. Subtract dividends paid, that's the way that we pass it. Calculate goodwill at the acquisition date. Consideration paid, that's CIA fair state. Minus net identifiable assets on the sheet. If it's positive goodwill, now the picture is complete. Parent at the wheel, controllers 99. Subsidiary numbers, we had them blah blah blah. Let's see, get that share, yeah, we show them some respect. And the minor influence is the equity effect. Line by line for the subs. One line investment for associates. Ask for Breeze for head.
Accrual revenues. Accrual revenues are the revenue that have been earned but not yet corrected or recorded. You get me? For example, a bank has numerous notes receivable, interest is earned on the notes receivable as time passes. At the end of an accounting period, there will be notes receivable where the interest has been earned but not corrected or recorded. The adjusting entry for accrued revenue will be this now. You see, we have receivables, we have revenue. Now, receivables are debited, revenue are now credited. Adjusting happened because there might be error in somewhere, either in a transaction or in what? In data entry. That is, for that company, big corp company, yes, assume that on January 31st, 400 US dollar of repair work was completed for a client, but it had not yet been corrected or recorded. BDCC must record the following adjusting entry. You see, general account explanation. We have account receivables of 400, then we debit 400 of an account receivable, then we credit repair revenues. The reason is to adjust for accrued revenues. We have also account receivable and repair revenue. I'm sorry. So you interlink them. We have account receivable debited of 2,000 US dollar. Yes, we credit the repair revenue because the repair revenue is in revenue increases in the right side, The expenses are increased in the debit side. Now, we have debited account receivable, then we credit because these adjustments for accurate revenue. Where's what they have seen the transaction, I hope it's clear. We assume that on January 31st, 400 US dollar was completed but it had not been corrected for or recorded. Now we have to do what? To debit that account receivable because in our account receivable we have a given assets. Also, it appropriate to the given amount of revenue. That's what an asset account receivable is increased by the accurate account. That's the rationale. Now, on repair, an income statement account repair revenue is increased by the 400 US dollar of accrued revenue. If the adjustment was not recorded, assets on the balance sheet would be understated by 400 US dollar. And revenue would be understated by the same amount on the income statement. That's the rationale. Adjusting for accurate expenses. Now, accurate expenses are expenses that have been incurred but not yet paid or recorded. For example, utility bill received at the end of the accounting period is likely not payable for 2 to 3 weeks. Utilities for the period have been used but have not been paid or recorded. The adjusting entry for accrued expenses, we have to debit expenses, then we credit payables. Yes. We now the rationale in our general journal is to adjust for accurate expenses. I hope this is clear. Okay. Now we are going to see the accruing interest expenses. For the same company, the January 31st, 2023 unadjusted trial balance shows a US dollar amount amounted to 6,000 US dollar bank loan balance. By assuming there may be error, that's what the adjustment means. It is assume that's 4%. That is 60-day bank loan. It was dated January 3rd, which means that on what? On January 31st, 2028, days of interest have accrued. January 3rd, when you subtract 31st from minus 3, you will get 28 days of interest. Now, you see, we take 31st, let's see 3 days, then you get 28 as shown in the figure. Yes, that's a matter of calculating days. Yes, that's 28 days of interest has been incurred. at January 31st. We have a 60 days note. Interest incurred during an accounting period. The formula for calculating interest when the term is expressed in days is that interest is equal to principal times interest rate. Then you multiply elapsed time in days, then you divide the 365. That is interest when the time is expressed in days. That is the only rationale. That's the rationale. Now, the interest expense accrued at January 1st is calculated as we have interest, we take that principal of 6,000 US dollar times interest rate. They have given 4%, it was given, then we multiply 28 days that were elapsed over 365 days that elapsed, which is equal to 18 days, US dollar, which is rounded to nearest whole dollar. Remember, we don't need to write some points, 0.5, 0.7. You round it to $1. It will not be 70 point something. Now, you see the way with the has been just recorded. We have to record the interest by debiting interest expense, because interest is always in debit. The interest expense is debited. Interest payable is there, because interest payable are the same as liability. You know that simple formula. To adjust for accrued interest, we take the amount we multiply. When it is rounded to height for illustrative purpose in this, we have seen that when it is, we round to the next, but when it is below 0.5, we round it to the previous dollar. This adjusting, they are saying that this adjusting entry enable BDC to include the interest. Yes. Expense on January income statement, even though it is what the payment has not yet been made, the entry creates a payable that will be reported as a liability on the balance sheet at January 31st. Yes. We continue to, when the adjusting entry is posted, the account appears. What happened when the adjusting entry is now posted? Interest expense have been debited by 18. The interest payable is credited by 18 as well. You see, an expense account is established to record the debit, while the interest payable is established to record the credit. That is normal. On February 28th, interest will again it be accrued and recorded as what? Interest expense is debited by 18. Interest payable is credited by 18. You see, it was normal as what we have seen. What you do only is to record these transactions in the way. On March 4, when the bank loan mature, Big Dog will pay the interest and minimum principal and record the same transaction. Interest expense. Now, we have interest payable. We take this. How to record them? You see, because it is above 5, we round it to 3. Yes, interest expense and interest payable. Then we remove bank loan, because the bank loan is a principal amount. Interest payable is interest expenses. You see? You see, we got 6039. We are seeing the interest expense is the same as cost of finance cost. That is the same FRC. They say finance cost, whatever I can say, either interest expense. The 36 debit to interest payable will now cause the interest payable account to go to 0 since the liability no longer exists. Once the cash is paid, notice that the total interest expense recorded on the bank loan was 39. Now 18 expensed in January, 18 expensed in February, and 3 expensed in March. The interest expense was matched to the life of the bank loan. That's the rationale. That's why it will be used in, we are receiving that in a adjusted income statement. Their interest retained earning will be increased. Accruing income expense, income tax expense. Another adjustment that is required for big corporation of the recording of corporate income tax in most jurisdictions. A corporation is taxed as an entity separate from its shareholders. For simplicity, assume that BDCC is income tax due for January 2023 is 500 US dollar. To adjusting entry is at January 31st. Now, income tax expense is 500. Income tax payable is 500. To adjust for January accrued income tax, that's the narration. Remember, that is not the account, that is open format. When the adjusting entry is posted, the account appear as follow. We have income tax expense when we have income tax payable. Income tax expense is debited. When income tax payable is credited. By understanding that is payable, it's already credited. Or income, when it is income, the above adjusting entry enables the company to match the income tax expense accrued in January to the earned during the same month. Now, let us see how each of the 5 steps of for adjusting entries, either debits or expense or credits revenue. Adjust prepaid asset by recording. We debit expense, we credit prepaid. Adjust an earned liability by recording. We debit an earned liability while we credit revenues. Cost is an earned liability. Adjust plant and equipment asset by recording depreciation expense. That's what all of those transactions must be done. Depreciation expense, accumulated depreciation is debited. Adjustment for accrued revenue by recording revenue receivable. Yes. Now credit revenue cost the amount we have received. Adjust for accrued expense by recording. Here we debit expenses, we credit liability. Now, it is summary of 5 types of adjusting entries as we have seen. Adjusting trial balance. That is what we are going to see. Before we move or we now we are almost done, okay? Don't worry, we will be going further. In the last section, adjusting entries were recorded and posted. As a result, some account balances reported on the January 31st, 2023 and adjusted to balance in figure 2 have changed. Recall that an unadjusted to balance report account balance before adjusting entry have been recorded and posted. That is the general. An adjusted true balance report account balance after adjusting entries have been recorded and posted. You see, the preparation of financial statement was demonstrated using BDCC, an adjusted true balance. We now know that an adjusted true balance must adjusted true balance after all changes have been done. Wait a little bit, I'm coming.
Yeah. Let's check the books tonight. See where the numbers align. Every calculation, every line. Setting up the balance of time. Measure the strength, to me what's due. Current assets to liabilities, keeping it true. Current ratio, checking the short-term flow. Quick ratio, dropping inventory, watch the quick cash show. Cash ratio, standing on a firmest ground. Working capital, keeping my head up sound. Then we look deeper to the long-term state. Solvency ratio to starting the fade. It's a balance sheet of the heart and mind. Calculating every ratio clearing all the liabilities away. Balance the sheets today. Oh, yeah. Now let's look at what the venture brings. Profitability, vanillity, the business sings. Gross profit margin on the top line scale. Operating margin, making sure the operations prevail. Net profit margin shows what truly stays after every single cost is paid its ways. Return on assets, using what we hold. Return on equity, turning paper into gold. Gross mirroring the capital deployed, making sure the value isn't getting destroyed. Now turn the wheels, look at activity rate. How fast the assets move through the gate. Inventory turnover, sell it fast. Days inventory outstanding, make the cash cycle last. Accounts receivable, collect what's due. DSO, deep or low, keeping payments running through. It's a balance sheet of the heart and mind, calculating every ratio we leave behind. From liquidity flow to the bottom line, keeping every ledger in perfect time. Oh, we're balancing the sheets today, clearing all the liabilities away. Balance the sheets today. Oh, yeah. What is the overall cost of raising what we need? Equity is expensive, expectations run deep. Debt is cheaper, interest tax deductible and lean. WAC brings the harmony right in between. Waiting cost of capital, balancing the scale. Equity and debt combined, so we never fail. Numbers for the forecast ahead. Auburn Z predicting where the path is led. 1.2 times working capital, 1.4 retained, 3.3 times EBI. Keep the profits gained. 0 growth, 6 market value. 1.0 sales in line. A safe Z score means we'll stand the test of time. Before we sign off and close the year, materiality brings the picture clear. Profit before tax, 5 to 10%. Setting the threshold for where the focus is spent. Revenue, total assets, equity and gross. Checking the benchmarks where it matters the most. High materiality, less detailed test. Low materiality, still we do our best. It's a balance sheet of the heart and mind, calculating every ratio we leave behind. From liquidity flow to the bottom line, keeping every ledger in perfect time. Oh, we're balancing the sheets today, clearing all the liabilities away. Balance the sheets today. ituje hagati itazumunota zirageze ntekereye ahubanye ubuzima bwanjye umutima uzuye gushima nakangutse mu gitondo uramfata undinda ibikuba n'imitego y'umwanzi ngezemo amahoro mwami yesu warakoze rwose yesu wanje ubuntu bwawe ni bwiza ungose kuba mu gitondo na shimye kompa ubugingo kubawe ndagushimiye kuri saa sita nziza amasaha genda nanje mwami ubuntu bwawe bubanire nanje kugeza munsi urangiye imbaraga zanjye zangize wowe nta n'ubwenge bwanjye bunganja ni urukundo rwawe rutagira urugero ni ubuntu bwawe bungoboka buri munsi mu n'umuryango w'inzira ndefu intambwe zanje uzirinda kuyoba yesu uratatswe uri wagihamya hiro biwukwiriye yesu wanje ubuntu bwawe ni bwiza bungose kuba mu gitondo na n'ubu shime kompatse ubugingo bwawe ndagushimiye kuri saa sita nziza amasaha ari bukurikireho ndayakuragije genda nanje mwami ubuntu bwawe bubanire nanje kugeza munsi urangiye aleluya amasengesho muri ya buhoro yo amasari imbere nayawe ubuntu bwawe ungane aleluya niange Fabrice Yesu wakoze amen amen.
Angel Fabrice, Mahari on the track.
Yeah, one big group, multi-company vision, line by line, bringing balance. Parent at the top, yeah, we holding control. Let's combine the numbers and construct the whole. Parent at the wheel, control is 99. Subsidiary numbers. cancel out the internal, wipe away the noise. New financial statements. Big flex, boys. Start with the parent, holding 50 plus one. That's control, step inside. Now the takeover's done. Got a subsidiary rolling under the umbrella. Consolidation time, let me fella. Rule number one, take the revenue and cost. Add them 100%, no details get lost. I'll set for asset liability to match at the whole balance sheet. The intercompany trade, cancel out the sales and the management fees. Pay the parents on the sub and they kept a realized gain. Eliminate the profit or the margins won't stay sane. Parent at the wheel, controllers 99. Subsidiary numbers, we had them line by line. Cancel out the internal, wipe away the noise. With financial statements, that's a real big flex, boys. Now, what if we don't own 100% of the piece? Into NC interest lease, they own that remaining bit, 20 or 30%. Show the sharing equity where their money went. Now look at company 3, we got significant influence, got 20 to 50. Just a footprint, that ain't a sub, that's an associated in the net. No line by line added, that's a standard you reset. Highest 28 equity method on the scene. Start with initial at our share of the profit to the single line asset. Subtract dividends paid, that's the way that we pass it. Calculate goodwill at the acquisition date. Consideration paid, that's the fair state. Minus net identifiable assets on the sheet. If it's positive, so it's complete. Parent at the wheel, controllers 99. Subsidiary numbers, we had them line by line. They see, guess they share, yeah, we show them some respect. In the minor real, the effect. Line by line, subs. One line investment for associates. Ask for brief ahead, drop the breakdown.
Now we proceed on the what we call the preparation of the statement and the adjusted variance, because we have seen out of the previous adjustment they are ready for being recognized by now. We can proceed on just balancing or adjusting the trial balance, because when other adjustments are done, nothing other than just adding the common or the set of adjustments they brought. That's what brought to adjusted trial balance. Because what's matter here is ensure that what we have adjusted is now the breakdown over there. In the last section, adjusting entries were recorded and posted. As a result, some account balances reported on the January 31st, 2023, an adjusted trial balance in figure 2 have changed. Recall that in an adjusted trial balance reports, account balances before adjusting entries have been recorded and posted. In an adjusted trial balance report, account balances after adjusting entries have been recorded and posted. Figure 3.5 that we balance for BDCC at January 31st, 2023 have done in as well because it combined chapter 1 and 2, which where the preparation of financial statement was demonstrated using BDCC and adjusted trial balance. Now that an adjusted, you see all of those 25, you remember we have seen the 5 in the depreciation, all of those transactions that we have seen there, we come there and update them, which will bring, we remember before it was 7, before adjustment. We have a sum of $27,000 US. Before adjustment, please. Before adjustment, let me check the page we are on so that I will make a retro. Okay, I'm going to show that there we had before adjustment, we have 27 balance. 27. You see, that is the rationale. Before adjustment, there was 27,000. That means that the logic is that we have tried our best so that all of what we have seen contributed to an increase in almost 1,000, I think. 1,000 US dollar. Good. We continue using the adjusted trade balance. Now we are going to see to prepare financial statements. I'm sorry. This trade balance is going now to help us design appropriate financial statements. Yes, in the last section, we saw that the adjusted trade balance is prepared after journalizing and posting the adjusting entries. Yes, we have. This is what we have finished to see. Now, this section shows how financial statements are prepared using the adjusted trade balance. You see, using the adjusted trade balance to prepare financial statements. Now, Big Dog Corporation adjusted trade balance January 31st, 2023. The assets, yes, cash account receivable, reinsurance, equipment. They are saying that those are balances we debited. Those debited are just. This practice is just part of while expenses and revenues. This is the revenues, interest payables, yes, finance cost, yes, assets are the balance sheet. So what would you see? Income tax payable, yes. All of these parts will be used to prepare balance sheet. And the net income rose from the now to prepare the statement of change in equity we have seen in chapter 2. Revenue and expense account to prepare the income statement. That is normally understood. The total should be brought, the total debit and the credit should be equal under no circumstance. The income statement is prepared first, followed by the statement of change in equity as shown below. Look at the way. You see, I have managed to let you know that you have seen this 25. That is the depreciation. Every single transaction we have made should be reflected here, because they will adjust our balances. Now look at our adjusted trial balance as at date. Dividends are normal, but accumulated position here is there is. Therefore, this part will be used to generate income statement. This grade you add. You see? Salaries, expenses. We have revenues. It almost 10,700, which is aggregate total. We remove all of those expenses as illustrated there. This 18. We have 18 of interest expenses. This and 25 depreciation we have seen also, and these 18 have been calculated. Do you remember in prepaid? And yeah, good. Now, see the statement of change in equity for the month ended January. After preparing statement of income statement, now we prepare statement of change in equity, which is now net income is transferred to the statement of change in equity as part of retained earning, or automatically. Before we had it to 12. Net income, it was 2,000. I remember it well. Not only. It was 10. We didn't compute the net income. It was 10,200 of the earnings, which was negative. 200. Later, the effect of you see, we have before change, we have net income of 200. I remember it. And then we removed the 200 of dividends to our shareholders. We going to affect our statement of change in equity. You see that the rationale here is that our net income has reduced from almost $143 US. Thus, the total equity is also reduced. Well, that is these accounts are used to prepare the balance sheet. This one in a blue. You see, after statements of change in equity, now we are going to prepare statement of assets and liabilities. All of those parts are used in the statement of assets and liabilities. Cash, yes, of course. Prepaid insurance is the asset. Equipment is the assets. This accumulated depreciation, which is just there. Track. This accumulated depreciation of 100 as well. Liabilities, bank loan, account payables, interest payables, the profit, yes, yes, income tax payables, yes. Now, total liability is adding them together to be equal to total assets. Total assets and equity. Share capital, we have 10,000. Retained earnings is now 1,857, because we have seen that there was a 11,857. Good. That is what we have to retained earnings 1,857. Good. Now we got total liability and equity, which is 19,150.75, which is clearly equal to our total assets. Now, is balanced. The concept of the accounting cycle was introduced in chapter 2. The accounting cycle consists of the steps followed each accounting period to prepare financial statements. These 8 steps are: step 1, transactions are analyzed and recorded in the general journal. Step 2, the journal entries in the general journal are posted to accounts in the general ledger. Step 3, an unadjusted trial balance is prepared to credits. Step 4, the unadjusted account balances are analyzed and the adjusting entries are generalized in the general journal and posted to the general ledger. Step 5, an adjusted trial balance is now prepared to prove the quantity of debits and credits. The adjusted trial balance is used to prepare financial statement. That's step 6. Step 7, closing entries are journalized and posted. Step number 8, prepare a post-closing trial balance. Step 1 through 6 were introduced in these and the preceding chapters. Step 7 and step 8 are discussed in the next session, which is closing entries are generalized and posted. Now prepare a post-closing trial balance. Now, what's the closing process? At the end of a fiscal year, after financial statements have been prepared, the revenue, expense, and the dividends account balance must be zeroed so that they can begin to accumulate amounts belonging to the new fiscal year. To accomplish this, closing entries are journalized and posted. Closing entries transfer each revenue and expense account balance, as well as any balance in the dividend account, into retained earnings. Revenues, expenses, and dividends are therefore referred to as temporary account. That's what we have. I was telling you. That is what in this music of mine.
And Fabrice, Mari on the track.
Yeah, one big group. We went. Now look at company 3, we got significant influence. Got 20 to 50% I control, just a footprint. That ain't a sub, that's an associated. And that's a standard you reset. IS 28 equity method on the scene. Start with initial cost, keep the ledger fresh and clean. Add our share of the profit to the single line asset. Subtract dividends paid. will at the acquisition. Consideration paid. That's CIA fair state.
That's what I was telling you, that you better understand that nothing is remained when all of those statements we have to zeroizing or zeroing to, so that we can began to accumulate months logging to the new fiscal year. To accomplish the closing entry are generalized entries transferred each revenue and expense account as well. Now, we see that revenue and expenses and the dividends are now therefore referred to as a temporary account. Those, why do we call them temporary account? They are temporary account because they will not be transferring any balance in the next fiscal year. That is the only rationale. Because their use is only in the current fiscal year. That's the rationale. The balances are a zero accounting period. Balance sheet accounts such as retained earnings are now permanent accounts because I have finished to say that they are going into balance sheet and they appear through different fiscal years. Only permanent accounts are those final statements. Others, they are temporary. Their balance are restored at the end of each accounting period. Balance sheet accounts are permanent account because they have a continuous balance from one fiscal year to the next. The process transfers the closing process transfers temporary account balance into a permanent account. Yes, only what you have to brought is their balances, but the counters account is remain in one fiscal year, not to be transferred in another fiscal year. Now, the closing process transfer temporary account balance into a permanent account, normally retained earnings. The flow entries in the closing process are retired. Look at here, we are going to. Let's move quickly. Entry number 1, close the revenue account to the income summary account. What is the income summary account? Income summary account is an income statement. Most of a single compound closing entry is used to transfer all revenue and expense account balances transferred. Closed to the income summary, the balance in the income summary account must be equal to the net income or loss reported on the income statement. telling you. Yes. The revenue and expense were not balanced correctly if they are not balanced. Entry number 2. Account to the income summary account. Yes? Closed in one compound closing January to the income summary account. All expense account with a debit balance are credited to bring them to zero. Their balances are now account as an offsetting debit only rationale. After entries number 1 and 2 above are posted to the income summary account, the balance in the income summary must be compared to the net income loss reported on the income statement. If the income balance does not match the net income loss reported on the income statement, and the revenue and or expense were not correctly, that is what I was correctly, that is number. Yeah, that is the same. Okay. Now, 2. We finish number 2. We see entry number 3. We cross the income to retained earning. But keep one. We have crossed the revenue account to the income summary account. Second, we cross the expense account to the income summary account because where we have income, we have expense as well. They are correlated. Now, third one, we see that which is the last, the before we finish. The income summary account is now crossed to the retained earning account. With this procedure, transfer the to retained earning. Again, the amount from the income summary to retained earning must always equal the net. Yes. Raw income statement must be there as well. Account is not just crossed to the income summary account because dividends is not an income statement account. No. The dividend account, entry number 4. Let us look on entry number 4. Let us see entry 4. This is where we're missing the useful of this checkpoint. Now, entry number 4, we cross dividends to retained earnings. The dividends account is crossed to the retained earnings. The retained earning account. This result in transferring the balance in dividends temporary account to retained earnings, which is a permanent account. The only remember those current accounts, those are them current accounts. Yes. Those are current accounts. Yeah, let us call them. They are current account. They're not permanent account. Okay, they are current account, no problem. This results in transferring the balance in dividend or temporary account. Okay, later, another term here we say, or temporary account. I was missing this term. Temporary and current, they are the same. They are temporary account. To retained earnings, a permanent, which is retained earning, which is also a permanent account. The balance in the income summary account is transferred to retained earnings because the net income or net loss belongs to the shareholders. The closing entries for Big Dog Corporation are shown here. Remember those transactions, we have seen them, nothing there complicated. Here, let me go and show you each single thing. These are dates, description, you see, description, see, here there is Jano 41. We have debit side, we have credit side. Now, all of these parts, these are details. Complicated. Where am I? My computer is jumping. Good, we're back. Now you see revenue, repair revenues, it's a sum of what we have. All of those journal entries are general journal. That is the general journal. That combine all of the journal. All of the transaction that took place in our activities here, those they take place there. I hope they think everything is clear. Okay. Okay. At the end of the day, we should be having 28. 28 out of the general, the summative total. Posting the closing entry to the generator. 1, 2 are posted to the generator. The balance and expense accounts are transferred to the income summary account. The transfer of these balances is shown in the figure we are seeing. The notice here is that a zero balance result for each revenue and expense accounts after the closing entries are reported, and there is a 2,075 credit balance in the income statement summary. Why? The income summary balance agreed to the net income reported on the income statement. Let us see how it results. Remember, the number one, we have expense, we have 25 which is debit. In what? The prepayment. Prepaid insurance, I think so. This is a depreciation. This is a depreciation expense. That is that is here. That is the depreciation expense. This is a depreciation as well of 100. Remember, we have insurance expense. That was I was telling you. 200. When you add all of those transactions, they become 200, 300. There is rent expense of 1,600. Salaries expenses. All of them. Income tax expense and truck operating expense. All of the temporary expenses are accumulated to the income statement, then they reduce all of these expenses that are here. All of these are the temporary accounts. We just brought them into an income summary. That income summary is only the permanent account. That is the only permanent account that will be brought through two different fiscal. Now, the closing revenue accounts, yes, we have repair revenue. Now, you see that we buy them. We have debited the repair revenue because we are going to transfer that, yes, into income summary so that we accumulate everything. Nothing is challenging. All of the debit are accumulated. In the income, we have the only one income, which namely closing revenue account, repair revenue, or the main activity of the business was just repairing business. Summary is closed to retained earning. And the third closing entry, 057, credit balance in the income summary account is transferred into retained earning, as shown in figure 3.12. As a result, the income summary is left with a zero balance. That's the rationale. Closing the income summary account, we have to ensure that these balances are just transferred. Look at here, the difference between 8,643 US dollar minus 10,700 US dollar. The difference is 2,057, which is brought to the retained earnings. And it will just go to finance what? Our total equity. Then our total equity become big because of what we have done. Closing the income summary, that's the rationale. This example demonstrated closing entries when there was a net income. When there is a net loss, the income summary account will have a debit balance. Look at, where do we have a debit balance when there is a net income? Because 10,000 is bigger than 8,000. That means the balance, yes, that we have here a credit balance which is positive. And they are telling us when we have when this 10,000 should be in debit side, we should have occurred a loss. Now, to close the income summary account when there is a net loss, the following closing entry is required. In case we have a loss, we debit credit income summary. To close the net loss, a debit balance in the income summary to retained earnings is closed to retained earnings in the fourth closing entry. The $200 debit dividend account is transferred into retained earnings, shown in the figure 3. We are seeing that. After the closing entry is posted, the dividend account is left with a credit balance of 187. Notice that 1857 must agree to the retained earnings balance calculated on the statement of change in equity. They should. We have dividends. We had dividends before of 100. That dividend will be reducing the retained earnings. We have repeated yesterday. Even though we have before we have 2057. That's why now post closing trial balance. A post-closing trial balance is prepared immediately following the posting of closing entries. The main also is to ensure that the debits and credit in the general ledger are just equal, and that all temporary accounts have been closed. The post-closing trial balance for Big Dog Corporation appear below. Now let us see the post-closing trial balance. Most of the people don't know that we have such 3 types of trial balance. There is adjusting trial balance, there is an non-adjusted trial balance, there is a post-closing trial balance, which is the final one before we produce financial statement data. Some of the company don't produce them, but it's very good when you prepare them. A post-closing trial balance is prepared immediately following the posting of all closing entries. The purpose is to ensure that the debits and the credit in the general ledger are equal and that all temporary accounts have been closed. I've told you. You see now, we are going to see some of the change. Permanent accounts remain here. Yes, we have all of those lists they have been updated. Do you see? We have just dividend have been reduced today. We only remain with all of that or the balance after adjusting. Let us see the previous trial balance so that you can the balance which is not adjusted, the one that containing, look at, we had 28, you see? See, we have 28, 143. These accounts are used to prepare the transaction. We no longer need them. Yes. We no longer. Only we go with balances. That's why in our post-control balance, we will remain with 90,300. Note that balance sheet accounts, the permanent account have carried forward to the next accounting year. And the new fiscal year with a zero, so they can be used to accumulate amounts belonging to the new time period. This thing should be, because they can challenge you. That's why accountants should be aware. Because when you go without zeroizing the, you can either say this is May 2026, you correlate it with May of 2027. That's the rationale of zeroizing this balance. Financial statement in time array basis, yes. So that at a minimum once per fiscal year. But remember here we have seen that listed companies, some limited public limited company, those that call people to invest in their shares, they may even prepare financial statement triple a year, every end of 4 months. That is a irregularity, but normally other preparations are done once a year. For statement to reflect activities accurately, revenues and expense must be recognized and reported in the appropriate accounting period. In order to achieve this type of matching, adjusting entries need to be prepared. You can explain the use of prepare the adjusting entries required for preparing expense, depreciation, another revenue. All of those, we have seen them, no problem. Everyone can now be able to illustrate the financial statements the way we have seen. I think that's come to an end of this course today. I have seen 2 attendees. It is not easy. Others will come to see. No problem. When we are just starting, it's okay. And some of examples are being explained. At the end of the day, when you want, you can share the issues in the comments. The purpose is well understood. Come on, advance your skills and ensure that temporary account are closed. Take away with something at least. Now, next chapter is the fire the balance sheet and they detained the closures. That is the end of our session today. Let me thank everyone who has just viewing those fellow viewers. Thank you. See you in the next chapter, next YouTube analysis in our usual way. Thank you.